if you look at the last 30 years, equities in India have basically delivered 30x return. And I think Nifty has grown at a CAGR of 13%. And if people invest at 10,000 rupees, I think it will be something like 2.4 lakh rupees today.
What I'm trying to say is not to say that fixed income or bonds are likely to outperform equities. Far from it. I still believe that equities is a great asset class. But what I'm trying to say is that we should not get carried away to make it a gospel truth that equities is the only way to make money. 25 years ago, every presentation of mine started with what is a mutual fund and explaining the basics of the industry. Today, of course, everybody knows what it is. People have got more and more sophisticated, as you said. Products like SIPs have become the way this industry has really reached out to investors. What I find really interesting is the cumulative returns over the last now 29 years from Nifty and the ISEC Sovereign Bond Index are basically the same.
They are the same.
They are the same. When equities outperform, the equities outperform a lot, right? So, it's when that's why these percentages, these stats need to be looked at a little carefully. Do not extrapolate short-term performance to long-term. Just because last 3 years returns have been great. It doesn't matter which asset class. I'm not talking about. Don't assume that the next 5, 10, 15 years will look like the last 2 or 3 years.
Correct. Hi, and welcome to another episode of Open Dialogue. Today we cover a very interesting topic. We have all known equities as a way of creating wealth. In today's topic, we take a completely different asset class, fixed income, and talk a little bit about this asset class and how it has performed and what drives the economics of this asset class. So joining me today is Siva. Siva is the head of fixed income at Axis Mutual Fund. He has more than 25 years of experience in the mutual fund industry. He actually was part of 2 startup streams in the mutual fund space, first with ABN and also with Axis Mutual Fund. And I'm sure we'll have a great conversation with Siva. So Siva, welcome to the show.
Thank you, Samir.
Great. So Siva, let me start with a few statistics, right? So first is, if you look at the last 30 years, equities in India have basically delivered 30x return. And I think Nifty has grown at a CAGR of 13%. And if people invest at 10,000 rupees, I think it will be something like 2.4 lakh rupees today. There are a very large number of demat accounts that have been opened in the country. Obviously, people have started investing a lot. And SIP volumes, as an example, I think have doubled in the last 5 years from some 7,000 crores to now approximately 17,000 crores. So, in the context of all of this, obviously a very large part of the country now has started investing in equities. And there is almost a gospel truth that equities is a great way of, creating wealth. So it will be great to, I'm putting you on a spot a little bit here, but it will be great to understand your perspective on this and contrast that to fixed income a little bit.
Thank you. So first of all, I have absolutely no disagreements with anything that you have said. Fantastic asset class, long-term, great way to make wealth. And I think investors have, over the last, like you said, I've been in this business for 25 years. 25 years ago, every presentation of mine started with what is a mutual fund and explaining the basics of the industry. Today, of course, everybody knows what it is. People have got more and more sophisticated, as you said. Products like SIPs have become the way this industry has really reached out to investors. Obviously, we've made such a great success of equities. I don't think in the industry we've really touched as much on the fixed income side. I hope this conversation changes some attitudes towards fixed income as well. Some of the things that I'm going to talk about obviously will be pertaining to past performance, and it's very important to understand that these stats and discussions that we will have pertain to past returns and may not necessarily be carried forward to the future. This is very, very important in any kind of investment decisions. Please look at the past, understand the past, but don't assume that the past is going to get repeated in the future. You made a very important point about the last 30 years, right? That's it. Returns from equities have been spectacular. It just so happens that about 30 years ago is when NSE started, right? And then we have Nifty data going back from about 1994.
Right.
Around that period of time is also when India started liberalizing interest rates.
Right.
And we started seeing a development of the GSEC market. And it so happens that ICICI Securities started an index of sovereign bonds called the ICICI Sovereign Bond Index, also going back to 1994. So now we have close to 30 years, but close to 29 years of data which shows the relative performance or just the performance of these asset classes in India over really long periods of time. What I find really interesting is the cumulative returns over the last now 29 years from Nifty and the ISEC Sovereign Bond Index are basically the same.
They are the same.
They are the same. Give or take, right?
Yeah, sure.
And that incidentally was true when we started Axis Mutual Fund in 2009. I looked at the data from 1994 to 2009. The returns were broadly the same. And now, 14, 15 years later, 1994 to 2023, roughly the same. This is not something which resonates with anyone because it's like you said, the gospel truth is equities are the best way to make money in the long run. I think equities, yes, is probably the best way to make wealth. But when we look at equity performance or when we look at asset wealth creation, we look at the data that's available to us. Right? We have data from India. Obviously, we are in India. We have data from India. We look at the rest of the world and we look at, for example, data from the US, which is the market which is the deepest, largest and the best researched. And this returns from the S&P 500 have been spectacular over the last same period of time, 10, 20, 30 years. But if you look a little wider afield, it's mixed. If you look at countries other than the US in the Western world, for example, the UK, look at the FTSE 100, you look at France or the CAC 40. Come to Asia, look at China or Hong Kong and many of the Asian countries. The returns over the last 20 years have been meh. For practical purposes, many of these indices are trading at the same levels they were trading at in the late 90s. Back, 20 years ago. So they made no returns over really long periods of time. And that, of course, this is related to economic performance. The fact that the US has done well, the fact that India has done well means that the stock markets here have done well in relation to countries which have not done as well. China is an exception where the economy seems to have done well, but the stock market has not performed really well. What I'm trying to say is not to say that fixed income or bonds are likely to outperform equities. Far, far from it. I still believe that equities is a great asset class. But what I'm trying to say is that we should not get carried away to make it a gospel truth that equities is the only way to make money. And it's very important to have a so-called asset allocation approach, which is to basically make sure that you have enough of different asset classes in your portfolio because these asset classes perform differently across cycles.
Yeah, great. Siva, you kind of mentioned a fact which is a little incredible, and so I just want to ensure that I understood it right. So, government bonds between Indian government bonds between 1994 and 2023 have broadly given the same returns as Indian equities between 1994 and 2023.
Yes, just comparing one index which existed from then, because we don't have, many bond indices don't have 30-year history. So, the one index which does have that history, and of course Nifty, again, going back to the same period of time, caveats apply, like I said, past performance, etc. So, there are very important caveats.
Sure.
Yes, but so the cumulative returns does look very similar.
Similar. And because this is government securities, is it right to say that it has come at a lower risk?
Yes, obviously in terms of government securities cannot default, right? So therefore, there's no credit risk.
Right.
The volatility is much lower than equities.
Right.
So obviously, from a price risk as well as from a credit risk or from a potential loss of capital, obviously investing in bonds or investing in GSEC specifically is much lower risk proposition. Again, I'll caveat this by saying it's not to say that this is lower risk and better returns or whatever it is, right?
Absolutely.
So we shouldn't read too much into it, but yes, over this period of time, that's been the case. What is really interesting is, so this is point to point. So obviously there's going to be a question that's raised that, what happened in 1994, what happened in 2023, that's the reason why these are looking similar, and that's a fair question. So instead of looking at a cumulative 29-year returns, if you break that up into 5-year rolling periods,
Right.
so you look at every month and then look at the 5-year past performance of future performance, whichever the case you look at it, and compare the two indices, you find that equities outperform maybe 55-60% of the time.
Right.
That's just slightly better than a coin toss.
Right.
So which is another way of saying is we are in 2023, and if you were to ask me 2023 to 2028, is equities likely to outperform bonds? I would say it's as good as a coin toss.
Right.
Right. That is an incredible statement to make. Now, in the last 3 or 4 years, it is certainly the case that equities have outperformed bonds on a rolling basis.
Yes.
Okay. Given the spectacular returns that we've seen post-COVID, right?
Right.
So obviously, the recent history is very much in favor of equities as opposed to bonds. But when you look at the longer period of time, there's a cycle. You see a cycle of outperformance and underperformance, and even on a 5-year basis, it's difficult to say one does better than the other. It really depends on the economic cycle. Take a look at what happened in 2008 or 2013 when you had large drawdowns in equities, or 2020 for that, when you had large drawdowns in equities. Those large drawdowns really don't happen in bonds, and really that's the real reason why this 5-year cycle happens.
No, very kind of, I would say, as you rightly said, like counterintuitive statements, right? That even on a 5-year basis, maybe equities outperform 60% of the time. So there is that premium for risk, but that is maybe 10%. It is not always 100%.
Yeah, but when equities outperform, the equities outperform us a lot,
Right.
right? So
Right.
it's that's why these percentages, these stats need to be looked at a little carefully. That
Right.
yes, outperform maybe 55 or 60% of the time, but the outperformance then
Is
can
a
be
lot.
quite
Yeah.
a bit. So that's why 5-year cumulative returns, if you look at it, on average there is significant outperformance from equities. Now, if average 5-year returns of equities is significantly higher than bonds, then why is it that 25-year or 30-year the returns are so similar?
Right.
And that then becomes a question, that if average returns of two asset classes, one is slightly better, or then why is it that the better performing asset class doesn't do better over long periods of time? And I want to sort of talk about risk in a very different way.
Right.
If you look at, I use a term called drawdown, and drawdown is essentially a loss of your capital or a fall in the value of your portfolio, right? Why I want to make this mention is that if you lose 10% of your capital, right, and you make back 10%, you're not back to the previous high.
Absolutely.
Right? Because start with 100, 10% down, you're 90. 10% up from 90, you're only at 99. You're not reached 100 again.
Correct.
Right? This is the thing about risk. That risk is not symmetric. That 10% drawdown is not the same as a 10% rally. If you have 10% fall, you need 11% gain to go back. If you have a 20% fall, 100 going to 80, you need 25% to go back. And God forbid if you have in 2008, when your market fell by 50%, then obviously you have to double to go back to the previous high, right? So falls and gains are not symmetric, even though we use so-called the arithmetic standard deviation to express risk. It is not symmetric, and that is why the riskier asset class, whenever once in 5 years, 10 years, when you have large drawdowns, maybe because of a COVID situation or a global financial crisis, it kind of eats away a large amount of previous outperformance, right? So this cannot be predicted. Could you have predicted COVID? No way.
Yeah.
Could you have predicted the GFC? Maybe some people did to some extent, but certainly not the extent of the crash of the markets. So I think it's important to have this in mind, that how do you manage your drawdowns in your portfolio? And when I say portfolio, it's not just equity portfolio or debt portfolio, or total portfolio,
Overall portfolio
that we have.
Absolutely. So just to kind of summarize this part of the conversation, which is eye-opening for me actually, that over a long period of time, equities and fixed income have broadly done similar, maybe give or take a little bit here and there. In 5-year rolling periods, 60% of the times equities have outperformed, but that, as you said, that's a coin toss. And because risk is asymmetric, one has to think about drawdowns as well. And also you mentioned different geographies have performed differently. China, Germany, etc. have not done that well. Even countries like the US, I think, have had 10, 20 years when the equity markets have not performed at all and treasuries have returned better. And I think particularly in India, because so much of the investor base is 3 years old, because kind of many people started investing post-COVID, and they have seen a fantastic equity run. This is something to think about, that you want to have a portfolio which you can manage versus putting all your eggs in one basket because you don't know, as you said, 23 to 28, what is going to happen.
Yes. If I can sort of add one or two points there. One is, do not extrapolate short-term performance to long-term.
Right.
Just because last 3 years returns have been great, it doesn't matter which asset class. I'm not talking about it. Don't assume that the next 5, 10, 15 years will look like the last 2 or 3 years.
Correct.
Right? So it's very tempting to do that, but be very, very careful when we do that. The second is, and this is very important, that in the long run, we still do expect equities to do well.
Yes.
Because the economy is a fast-growing economy. Right? So none of what I say today should be taken as sort of to say that equities are going to underperform. No,
Absolutely.
I still believe that that's a way to make money in the long run. But the way to look at, understand the risk when you're making those decisions is the limited point I'm making here.
Absolutely. And hence, having a more diversified portfolio, thinking of allocation and so on and so forth. Fantastic. This is very, very interesting. So maybe, Siva, we dive a little bit into the asset class itself, right? Like fixed income. Can you just help us understand what does fixed income mean? And
Yeah. So at the core of it, again, it's good to contrast with respect to equities and fixed income, right? What is equity? Equity is a share in the profits of a company.
Correct.
Right? And to that extent, because the profits of the company can be volatile, the expected dividends or the returns from equities are uncertain. Fixed income, in contrast, the returns are determined by a formula. Typically, it's a fixed coupon, which means you get a certain rate of return on a bond. Government security pays, let's say 7% per annum, which means you get 7% per annum. There's no questions about what your rate of return is going to be. Certain fixed income instruments are so-called floating rate instruments, which means their coupon can change, but they're still set by formula. So in fixed income, the returns or the expected returns are kind of known in advance, right? There is still price risk. So obviously your returns are determined by both the coupon as well as the price movement. But to a large extent, the expected returns are known at the time of making your investment. And this is a crucial difference. So I think fixed income basically is an asset class where you get a coupon or a return or an income based on a certain formula or a fixed rate. So and that's a crucial difference with respect to other asset classes, right? So what goes into fixed income is really anything which, and the most common type of fixed income security is a fixed rate security which pays an annual or a semi-annual or otherwise coupon and matures at a specific date, right? So which means you know the start date, you know the end date, and how much you're going to make in between. So this is at the core of it what a fixed income instrument is. Again, unlike equities, which is permanent in nature, which is that this doesn't have a maturity, and the dividend rates changes as per the profitability.
Right. And so basically in the fixed income, hence contractually the borrower is obligated to pay you some interest, quarterly, annually, semi-annually, whatever it is. And if they don't, then they go bankrupt and all the other things happen. In the case of equity, if the company doesn't make money, you don't make money. Broadly, that's kind of the.
Yeah, I think in equities, and you touched upon it, and it's very important. In equity, the crucial risk is what? If the company doesn't do well, the stock price goes down.
Yeah.
So the price risk becomes a crucial risk.
Right.
In fixed income, the price risk is not so big. The volatility of bonds tends to be very low. But what can happen is if the company if it's not able to make money or goes belly up, well, you can lose your entire principal.
Right.
I mean, that's called credit risk.
Right.
The risk that you don't get paid,
right.
Your coupon and the principal, because the company goes belly up. So it's a very, very different risk. So another way of looking at it is that equities can be volatile and go up and down, and can go down quite a bit. In fixed income, the volatility tends to be very less. But if there is a credit event,
yeah,
it's like a digital event, and you lose a lot of money at once.
Right.
So that's something to keep in mind. Yes.
Understood. And so, what are different types of fixed income instruments, like different entities issuing it? And
see, the largest market in India by a long way is a government security. So as the government of India borrows money, the state governments borrow money. So that's the largest market by a long way. In addition, corporates borrow. So and then there are many small niches you don't really want to get into because they're much smaller. But by and large, if you look at it, the two large segments which borrow money are the government and the corporates. Investors into bonds are very different from equities.
Right.
In equities, you have domestic institutions, foreign institutions, and retail. In bonds, it's largely domestic institutions. There is negligible retail participation, and there is very, very small foreign investor participation. So it's largely a domestic institutional business.
And what drives that? Like, why would foreign institutions not buy, or why isn't retail a big participant?
Good questions. And various committees have been set up over the last 25, 30 years to answer this and largely failed at answering it.
Right.
So this is, at a much greater level than either of us, the answer to this question. But I think fundamentally, the kind of ease infrastructure that we have created on equity side, we were the first country to offer kind of demat, and settlement cycles, short settlement cycles, guaranteed settlements, and so on and so forth. So that infrastructure has not really existed on fixed income side, especially for retail. So it's been largely an institutional market. It's a large market, by the way. We didn't get to that when we discussed the size of the market. I mean, Indian equities, as we recently hit the $4 trillion mark, right?
Correct.
But about half of that is insider, which means owned by for example, public sector entities, government owns a large stake.
Exactly.
And private sector entities, the promoters own a large stake. About 50% of that is free float, right? So about $2 trillion of free float market capitalization of Indian equities. Indian fixed income market, bond market, $2 trillion. So the size of our market is comparable, and there is no such thing as promoter in debt.
Yeah, exactly.
It's borrowing, so everything is market. So the size of the market is comparable. The only difference is the investors are institutional, largely because of the structure of the market, which makes it much more harder for retail to participate. And foreign investors, has historically been a challenge for various reasons, but you've heard this news in the recent past that India is getting included in certain global bond indices, which should drive foreign participation. Just like foreign investors have invested in India because of participation in global indices, right? A big chunk of global money which has come into Indian equities is index linked, and not index linked as in only ETF and passives, but even active managers linked to indices which have India as a share in equities. And going forward, I think we should see a much greater participation by foreign investors as Indian bonds, starting with G-Secs, get included in global benchmarks.
Right. Now, so we spoke about corporates issuing debt and governments issuing debt. The two will obviously have very different characteristics, return profiles, presumably also investors. So if you could throw a little bit of light on.
Yeah. Interestingly, not so much the investors. Like I said, domestic institutions, banks, mutual funds, insurance companies, pension funds. They are the large investors. A little bit here, a little bit there, kind of, depending on their mandates, right? There may be a little difference. But yes, the characteristics are very, very different. Government is sovereign. It cannot default. The government of India can essentially print as much rupees as it wants to service its debt. So it cannot default on rupee debt. Corporates, that's not the case. If a corporate doesn't make money, this is a term we have all heard, NPAs. NPA is nothing but a default, right? A company has not been able to pay. All these cases that we hear about in NCLT, IBC kind of cases, are all because companies aren't able to repay. So in the case of corporates, the crucial risk is credit risk, just the inability to service that debt. Right? In the case of government bonds, that credit risk doesn't exist. But both government and corporate bonds also carry price risk, which is the risk of the prices of the bonds going up and down for other reasons, because of economic cycles, interest rate cycles. So there is a price risk. And Government of India tends to issue much longer duration bonds. And maybe we can get into the conversation of what is duration and all that. And that increases the price risk. So typically government securities carry slightly higher price risk, but no credit risk. And corporate securities typically, again, everything is typical. There are always exceptions, typically carry slightly lower price risk but higher credit risk.
And hence, so because there is credit risk here and not here, is it fair to say that typically corporate bonds would yield higher because they will, there is a credit risk inbuilt in?
Absolutely. And different corporates have different credit quality.
Right.
So corporate credit quality is measured by what's called credit ratings. So you have AAA, which is the highest, AA, single A, BBB, and so on and so forth. So as you go down that credit curve, typically the yields increase.
Right.
So a AAA bond would yield better than a sovereign. A AA bond would yield better than a AAA, and so on and so forth. So you get compensated for taking that higher risk by going by the higher coupon offered by those securities.
Understood. And as a retail investor, there will be many ways, I presume, to invest. One of them obviously is mutual funds, and I just gut feeling that is perhaps the largest way of retail to participate. So would mutual funds be like, is there a separate government securities mutual fund and a separate corporate, or like is there mixed, or how does it work?
So I want to step one step back first. For most investors, especially retail investors, fixed income and bonds are not actually very significant part of their portfolios, right? So to start with, I'm not sure whether that's necessarily people have looked at it as an asset class. What they do is they keep it in other fixed income instruments which are not bonds. So for example, you keep your money in a bank FD. It is also a fixed income instrument at the end of the day, right? Or you keep it in a corporate FD. So you get access to fixed income through something which is other than a bond market. Right? That is where a large part of
or PF or PPF
or even a PF or a PPF, right? So you keep it in any kind of these small savings accounts and you effectively get a fixed rate of return, and typically that is where most people have their fixed income allocation. When it comes to mutual funds, yes, you do have different categories: government funds which invest in GSECs, funds which invest in corporates, and funds which have a slightly higher credit risk, which typically invest in AA and below securities, and so on. So there are these different types of securities, different types of mutual fund schemes which invest in these different categories. That's a long conversation in itself. But mutual funds are just one way of accessing bond market, right? You do have these direct access to corporate bonds. There are platforms, there are wealth management firms which sell retail debt. You have, if you want to go down the credit space, you have AIFs and other funds which offer much higher yielding, lower rated, typically unlisted bonds, which are much higher yielding, but obviously carry significantly higher credit risk. So the spectrum of bonds tends to be quite large. So you can look at a government security. 10-year Government of India trades at about 7.25 today. You can go into an unlisted high yield security where the returns are like, or the coupons will be well into the double digits.
Right.
So that's the kind of spectrum that you see, that you can get a wide variety of fixed income instruments depending on what risk you want to take.
Great. So Siva, last question for this topic. There is this. We started with a little bit of a myth buster. We'll end with a little bit of a similar gospel truth, right, or notion, which is there is this notion that if you are X years of age, you should invest 100 minus X of your wealth into equities and the rest into fixed income. What are your thoughts around this?
Yeah, this is the classic. What do you call a portfolio, right? That you say that when you are looking to deploy your money, as you get older, you want to have less risk on your portfolio, and therefore you need to have a higher allocation to fixed income. And when you're young, you have greater ability to take risk, and therefore you can have a higher allocation to equity. It makes perfect sense. The crucial difference, why I have a little bit of a issue with simple models like this is that what is it that you're using the money for? If you're using your investments largely for yourself, a model like this works great, right? So you save, and then when you retire, you're going to live off that money. Perfect, makes a lot of sense. But most of us aren't investing like that, right? Because for example, take my own case. The way I look at my own portfolio is I kind of look at three buckets in some sense. One is what I call commitments. So, for example, if I have a mortgage to pay off, if I have kids' education or any other expense related to that, etc. So I need to have a pot of money which is linked to that. And obviously, depending on the tenor of that, I need to make sure that I don't take too much risk on that part of the portfolio. Obviously, if it is a long term, I can. The second part is the classic part, which is what I'm going to live on. Let's say me and my wife, what are we going to live on, especially after retirement? So that's the second part. And then what's left over, right, is either blow up money, right, or legacy. And for many of us, that part actually is important.
Right.
What is it that we leave behind for our kids, grandkids? If you look at it from that perspective, the 100 minus age makes no sense, because it's 100 minus whose age? It's not yours, it's probably your grandkids' age.
Yep.
So, therefore, your allocation may actually benefit from a much greater allocation to equities than what the model suggests, right? That 100 minus age works for that part of your portfolio which you expect to keep for yourself. And the part of the portfolio which you expect to sort of leave as a bequeath kind of money, I think you need to have a much longer term, and therefore the kind of assets that you own over there, you can take risk. You can invest in perhaps startup companies. You can invest in, obviously direct equity. I mean, equities and equity mutual funds and so on. Obviously, is important, but you can take different kind of risks, which different kind of investments which pay off over a much longer cycle than you think. So I think we have to have this sort of in our minds. We need to have a clear understanding of what my portfolio looks like. What are my goals? What am I saving for? And if we have that segmented approach, I think we do a much better than what a simple 100 minus age tells you. I keep talking to a lot of investors, and especially people who are significantly older, maybe into the 60s and 70s. And when I tell them this, it's like a light bulb goes off, right? Oh yeah, you're right. I'm not keeping this money for me.
Right.
And so I think and we are not really trained to, why do we do this 100 minus age? Because some US textbook probably said that. Right. But we are not living like Americans.
Right.
In America, what happens? When you're 18 years old, you get kicked out of your parents' house. And then you live on your own, and then the parents live on their own. That's not the way we work. So let's kind of create our own models. I think we need to have this multiple kind of portfolio approach if we do well for ourselves, our own investments.
Fantastic. Thanks a lot, Shiva, for that conversation. To just summarize this eye-opening for me. So, number one, in India, over a long period of time, over the last 30 years, equities and fixed income broadly have returned similar returns. If you take 5-year rolling, equities have maybe performed 60% of the time. When they've outperformed, they outperformed a lot, but also they've had drawdowns. And because risk is not symmetrical, that's why the averages kind of equate. And hence the importance of asset allocation and just not projecting 3-year returns to the future. Equities will continue to do well in India because India is a growing economy, etc. But there will be periods of drawdown, and hence people have to think of a portfolio. We also spoke about the different types of fixed income, and particularly we spoke about government bonds and corporate bonds and the difference between them, which is here we have interest rate risk and maybe a little bit of pricing risk. Here we have interest rate risk and credit risk as well, and which is why the latter yields more. And so when people think of investing in corporates, they also have to take into factor credit risk involved with that instrument. We spoke about how equity markets of different countries, like some countries have done fantastically well, like India, US, but there are many countries, and even in countries like the US, there have been long periods of time when the market has basically done very little. And last we spoke about, again, going back to the notion of asset allocation, it is important to think about what you want to achieve out of your various pots of money and allocate assets and portfolios accordingly, so that you are getting to the outcomes and you're not going by some simple rule books. It's a great conversation. Thanks a lot, Siva, for having us.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.